All right, welcome to the Explainer. Today, we are diving deep into a forecast for the entire global stock market. We're looking at the MSCI World Index, which covers thousands of big companies all over the globe, and we're going to see where the world's top financial minds think it's headed through 2029.
So let's set the stage. Our journey, our starting point, is right here. The MSCI World Index at 4,544. That was the number back on January 26, 2026. Think of this as our baseline as we look forward over the next 4 years.
And this right here is the big question, isn't it? So where are we all headed? By looking at analysis from places like Goldman Sachs, JP Morgan, and UBS, we're going to try to map out the massive forces and, just as importantly, the critical risks that are going to shape our global economy. Okay, let's get into it. Right now, the market is at what a lot of analysts are calling a historic inflection point. It's really caught in this fascinating tug of war. On one side, you have the incredible, almost unbelievable promise of new technology. And on the other, you've got the very real lingering pressures of a super complex global economy. So what's the main engine that's expected to push markets forward? Well, it all comes down to this one big idea, the artificial intelligence supercycle. Now, I know this is more than just a buzzword. It really represents a fundamental ground-level shift in the economy. Okay, so AI supercycle sounds a little jargony, right? But here's what it means in plain English. We're talking about a massive technological overhaul. Analysts see this huge wave of investment pouring into AI infrastructure, and they believe its eventual adoption across pretty much every industry will be the main engine for market growth for years to come. And you want to see the immediate impact? Boom, right here. This is so telling. The companies that are actually building the foundation of AI, the data centers, the semiconductors, all that stuff, they are seeing projected profit growth of over 20%. That is dramatically outpacing the rest of the market. But, and this is a really key insight, the benefits for everybody else don't just happen overnight. They follow this pattern that analysts call a J-curve. So first you get the massive spending. Then there's a period of kind of slow, marginal gains. The real explosion in productivity and profits, that's not expected to hit until 2027 and beyond, once this tech is really implemented far and wide. But it's not all smooth sailing and rocket ships. Not at all. This AI-powered journey is facing some pretty significant obstacles. There are major economic headwinds that could easily throw this whole optimistic forecast off course. Just look at the stark contrast here. This is what's called the valuation gap. The US market, which is super heavy in tech, is trading at a really high multiple, 23 times its projected earnings. The rest of the world, it's way down, closer to 15. What that means is the US market is priced for near perfection, which makes it pretty vulnerable if those huge growth expectations aren't met. And if those high valuations weren't enough, you've got this whole cocktail of classic risks brewing. We're talking about sticky inflation that just refuses to leave. The real danger of central banks making a mistake by keeping interest rates too high for too long, a not-so-small 35% chance of a global recession, and, of course, all the geopolitical instability going on. Any single one of these could challenge that whole AI growth story. So you've got this massive push from AI on one side, and this heavy pull from all these economic risks on the other. How does it all shake out? Well, by weighing these forces, analysts have mapped out 4 pretty distinct scenarios for where the market could go from here. All right, scenario 1. This is the base case, the most likely path in their view. You can think of it as the soft landing we've all been hearing so much about. In this version of the future, inflation cools down, AI fuels steady profit growth, and the market climbs at a healthy, consistent pace. Nothing spectacular, just steady. Then you have the flip side, the bearish scenario. This is the world where that sticky inflation just wins. It hangs around, central banks can't really cut interest rates, and the high cost of money just chokes off economic activity. Corporate profits flatline, and the market basically goes nowhere for 4 years. Now, what about the best case scenario, the bull case? This is the AI dream fully realized. That J-curve we talked about, imagine it accelerating way faster and stronger than anyone expects. This would ignite a massive tech boom, justify those really high valuations, and send the market absolutely soaring to new heights. And finally, there's this really interesting fourth scenario they call the Great Rotation. The idea here is that the super expensive US market kind of stalls out and takes a breather. And investors looking for growth rotate their money into more attractively priced international markets, like in Europe and Japan, which then take over as the main drivers of global growth.
Okay, let's put some numbers to these scenarios. This table lays it all out. You can see the median or consensus forecast for each year right there in the middle, but you also see the potential highs and lows. That range is huge. Now check out that last column, main driver. It tells a fascinating story. The AI supercycle kicks things off, then we get the real productivity gains, but look at 2029. Analysts see another massive force taking the lead, the energy transition. That global shift to sustainable energy is going to require enormous investment, create totally new market leaders, and become a huge driver of growth itself.
So that is a lot of different possibilities. And you're probably asking, how on earth do we know which path we're actually on? It's a great question. And fortunately, analysts have given us a few key signals, some quantitative triggers to watch that can act as our guideposts. The best way to think about these is like an early warning system on your dashboard. You've got three main gauges to watch. A valuation shock or an earnings slowdown outside of the big AI companies could be a red flag that the broader economy is in trouble. And a big interest rate spike means borrowing costs are getting expensive, which is like hitting the brakes on growth. Any of these could mean we're shifting away from that positive base case scenario. So after you crunch all the numbers, weigh all the scenarios, the good, the bad, and the in-between, what's the bottom line? Well, the consensus forecast boils down to this: an expected annualized return for the whole MSCI World Index in the range of 7.5% to 8.5% over the next 4 years. You know, at the end of the day, beyond all the charts and all the forecasts, it really all comes down to this one simple, powerful idea. The real test is whether corporations can take their massive spending on tech, their capital expenditures or CapEx, and actually turn it into growing profits. Can all the billions being poured into AI actually generate real spendable cash? That right there is the fundamental story to watch. And just before we finish up, a quick and important reminder. We're breaking all this down for informational and educational purposes. This is not financial advice, and of course, all investments carry their own inherent risks.